Any questions? That we'll go over how do we make the estimates. So there's two methods, but they're really three methods. So the two concepts are percent of sales method and accounts receivable method. So the two concepts, think of this as a branch, right? We have the direct write-off method here, then we have the allowance methods. In the allowance methods, we can use the percent of sales method or the accounts receivable method. The percent of sales method, we just thumb in the wind, what is a reasonable percent of sales? So 1% of our sales we write off, where we make an allowance for. Or we can do it based off our accounts receivable. So we can say 1% of our accounts receivable we're going to estimate and reserve for. The most accurate way is the aging of accounts receivable, which is I'll go into it, it's a little more complicated, but we bucket off how late an accounts receivable is and then give an estimate for each bucket. This is kind of the ranking of what is least accurate to most accurate. Percent of sales is probably the least accurate. Aging is the most accurate estimate. Percent of sales is the easiest. Aging is the hardest. So percent of sales is simple. Current period percentage of sales times a bad debt percentage equals our estimated bad debt expense. So every year or every quarter, we'll just do this estimate. So we have credit sales of $400,000. Estimate that's 0.6% of credit sales will eventually prove uncollectible. We'll just do the multiplication, and this is our estimate. Seems easy enough, right? Just memorize the percentage, know that this is the percent of sales method. Just apply the percentage they give you to the number. I'm not going to ask you to calculate the 0.6%. That's very complex. You'll learn that in future classes, but we'd go off historical information, right? We'd look at the past and figure out a reasonable estimate based off of our prior business. And to use this method, 0.6%, it would have to be around that percentage consistently in our past as a business. If it went from like 5% to 1% to 10% to 2%, we couldn't use this method theoretically. It wouldn't be accurate.
So I have a question.
Yeah.
If we establish a bad debt expense and suppose that everybody pays us throughout the year, do we true it up at the end of the year or every quarter, or when do we true it up that we got all the money?
Yeah, so you're consistently doing these journal entries that I just showed, where you're revising the allowance for doubtful accounts for when we receive money, and then at the end of every period, we redo the estimate, and so we'll true it up at that point. So we'll continue to make adjustments as we collect the cash, and then as we write off accounts, and then at the end of every quarter or every month or every year, depending on the company and their choice and policies and requirements, you will then reestablish the allowance based on the methodology we're going over here. Yeah, does that make sense?
Yeah, thanks.
Cool. No problem. Good questions. So we went over percent of sales. Let's make it a little more fun. Let's make it a little more difficult. Let's go over our percent of receivables method. So compute and estimate the allowance of doubtful accounts for receivables. This is a little more challenging because receivables are an asset account. So it adjusts. It's a rolling balance. It's not an account that refreshes every year, right? So we take the total estimated bad debt expense minus a previous balance and allowance account to get our current bad debt expense. You have to memorize this formula. What does this mean? We'll go over an example. So the same company, Musicland, has $50,000 in accounts receivable and a $200 credit balance. And this is also called ADA. Allowance for doubtful accounts is called an ADA account. ADA. On December 31st, 2017, past experience suggests 5% of receivables are uncollectible. So that 50,000 would be times 5%, which equals our 2,500. So based on the receivables, we would expect a 2,500 allowance for doubtful account at the end of the year. But then we'd have to go through our allowance for doubtful accounts to make the adjustment, which is what you were just asking about, Mujaba. This is an example of the receivables method. So we were saying at the beginning of the year, we had 2,200. We wrote off these three other accounts, 800, 700, and 500. And so at the end of the year, we had a 200 balance. we need it to be 2,500 based on this calculation. And so we plug 2,300. 200 plus 2,300 equals the 2,500. And we'll make that adjustment so it equals this 2,500. That's different than the sales method where we just put a flat rate, right? Here we're saying we're revaluing it based on the ending balance of accounts receivable. And then the journal entry is the same: debit bad debt expense, credit allowance for doubtful accounts, but the estimate is going to be the 2,500. So it wouldn't be the 2,500 plus a 200 previous. We have to true it up, just like you were saying with Java. Now to the hardest method, aging of receivables. So if you think about it, we know our customers who owe us money for a long time aren't going to pay us, aren't as likely to pay us. If I sent you an invoice, or think about this, if I did work for you and sent you an invoice and it's 30 days late, and I said to pay me in 30 days, I could be, oh, you know what? Maybe Christina, maybe she just owes me, like maybe she's just behind on her bills. Maybe I'll give her a call in a week. And let's say Christina, now it's been 2 months and I called her and she's like, oh, don't worry about it. I got you. I'll pay you back. Or maybe I sent a Venmo request to her or something. Don't worry, I got you. And then I'm like, okay, I'm not as confident anymore. It's been 60 days now. I don't know if she intends on paying me back, but maybe I still have some confidence. Then she stops returning my phone calls. It's been 6 months. Maybe at this time I say, you know what, maybe I'm not going to get my money, right? That's the same philosophy businesses take with their customers, right? Yeah, we'll see. Someone has a question here. Don't worry, Christina. Yeah, don't worry. I'm sure you'd pay me back. So the whole concept here is we are going to take groups and try to determine how likely customers in those buckets will pay us back. And we're going to estimate them based on the groups. And so that's what we'll see here. Say, hey, like the customers that don't owe us yet, only about 2% of those customers are going to default on us. They're not going to pay us. We think that most of our customers in this bucket are likely going to pay us. But then if it's 1 to 30 days past due, you say, you know what, they were supposed to pay us, but maybe they're a little behind. So we'll give them a 5% estimate. 31 to 60, 10%. 61 to 90, 25%. And then over 90, you're like, yeah, most of these customers probably forgot about us or don't want to deal with us anymore. And so what we do is by each customer, we'll determine how late they are on their bills, and then we'll bucket off the percentages. And so here we'll see Carly, Chavez, and Zamora each don't owe this money yet, a total of $37,000. And we take a 2% estimate, which will be our $740. We're estimating bad debt allowance for doubtful accounts. And we'll do that for each of these buckets. And so you can see like Balsia company is $900. It's 90 days past due. We might say we don't expect to collect most of this money. Right.
So I'm assuming that, during the COVID, all these percentages were kind of just, useless because a lot of customers were not paying on time, not because they didn't have the intention to pay, but they didn't have the money.
Yep. You're thinking about that correctly, Majava. That's a great observation.
Professor, then would the same thing apply in like a major economic depression?
Yeah, you're thinking any major economics and accounting overlap a lot. But anytime that there's a major shift or shock to the economy, you're generally going to impact all of your estimates. And so one of the big things you heard if you listen to any like news or any or read any financial statements, I don't know if any of you did that as light reading before this class, but if you listen to any news, a lot of companies were saying, we can't make estimates right now. Like, we're not sure. And why? Because of exactly this. Like now you're smart enough. Now you know, like, hey, if we're basing estimates off historical data, and then we know that we don't know what the customers are going to do. We know something's going to be different. We know less customers can pay, but we know our estimates are going to be off. But we can't change our estimates because we don't know what they're going to do, right? So that leads to a lot of uncertainty, and that uncertainty can drop the stock price because people don't know how to value the stock anymore. But yeah, great observation, Christina, and great observation, Mujaba. Any other questions related to this? So this stuff, like, it ties into our everyday life. Like, that's a lot of this is why the stocks had a major correction. And then as we change certainty, as stimulus comes out and things level off, like, hey, you know, those PPP loans or the PPE loans, that gives certainty to the marketplace that, hey, we might still be able to collect because there's money in the marketplace, and that kind of stabilizes the stock market. There's a lot more to it than that, but this is just a way you can relate to it. And so what we do here is it's the same method as the percent receivables method for the truing up. We just would true up the balance to what it's supposed to be. So if we had a $200 balance at the beginning of the period, and then we know it needs to be 2270 through our calculation here, we'd make the adjusting entry of 2070, the plug. So all of it's the same journal entry. It's just the way we came up with it is different, our estimate. And this is just showing you, hey, what if we wrote off another 500? We'd have to do an adjustment to 2770 to keep it to 2270. So sometimes we might have a debit balance. Sometimes our estimate was wrong, right? And so if our estimate's wrong, we still have to adjust it at the end of the period. It's okay if our estimate's off by a little bit. It's an estimate. So this is the big chart I was showing you. I think there's another thing up here. There's really methods. You have the direct write-off method over here. It doesn't exist. I'm just making it up. Direct write-off method. You're not supposed to use it, but you can. And man, accounting is confusing when I explain it, huh? You're not supposed to use it, but you can. So you can use it if it's not material. So judgment call, direct write-off method is the easiest. Then the correct ways to do it are through these bad debts estimation methods. You can do the income statement focus method, which is that percentage of sales, or balance sheet focus, which is an emphasis on what you can collect from your accounts receivable, which is your percent of receivables or your aging of receivables. This is the least accurate. This is the most accurate. This is the least difficult. This is the most difficult. I'd recommend if you're advising a business, if they have no accounts receivable or little, you could do the direct write-off method as long as it's immaterial. If they're very accounts receivable focused, you do an aging receivable, so you get more accurate depiction, right? So you kind of use it as a sliding scale. And then this is kind of the math behind it. So this is what you get on a quiz. You have your accounts receivable here, your percents uncollectible, all this will be given. And then you'll have to determine the uncollected amount. Easy, just do the math, multiply it out. You sum this to get your 49. And then our journal entries will be based off of this. So we'd have to make sure we do a T account. Our unadjusted is a debit of 10, they said. We know it should be 49. So our journal entry will be the 59 to true it up. And that would be our debit bad debt expense credit allowance for doubtful account. I went through it quick. You can go back through this video. I'm going through this quick so we can get to the midterm. You can rewatch this, but feel free to stop me if you have questions. And this is just changing the numbers. Go ahead.
Can I ask a question for the aging of accounts receivable? Like just like how to decide how long, if you're like decide to the customer will not pay you anymore, or like how much like percent do you give him or her?
It depends. There's best practices, but it really that's a judgment based. Normally you'll use a mixture of historical information, see what previous similar customers did, plus you might use industry best practices. But yeah, none of this is in a box. Alyssa, you bring up a good point. And I think a lot of professors aren't going to be able to give you this. That's the advantage of like me being in the marketplace and working. Like, we are going to look at everything and try to determine a best estimate. And then we don't just determine it, then the auditors are going to check us and tell us if we're wrong or right, right? So.
Yeah, thank you.
No problem. Good question. I gotta say, Alyssa and everybody, these are great. Like, these are the kind of questions that are going to make you better and better, is understanding the why behind it and how it all interacts. So really excellent. Like, these things, like, these are just a methodology to understand a situation, and we're trying to simplify and explain a situation through accounting so everyone can read it. It's the language of business, but understanding the transaction itself is where you add value.